All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Let's go out and break down some of the technicals on stocks in the challenge watch list and take a look at where a lot of those are and what we need to, what I'm looking for to go and make a trade there. Before we do that, though, market bathed in red here today and down about 29 points on the S&P right now. And you can see it pretty much opened up, and it was slightly red when it opened, and it's been all sell all day. It has just been all sell all day. It has not seen any sort of real material bounce that has any kind of significance. And, it is a very bearish sectoral picture here on the day. Consumer discretionary, financials, transports, industrials, getting taken to the woodshed, while consumer staples, utilities, and even healthcare to some extent really holding up and doing well here. So it has been a very bearish day in terms of the way the price action is and the way it kind of sits across the board. And it's been all selling all day. It's been all selling all day. Now, this morning on the open, I did something I very rarely do, and I made a trade right at the open, and that was to exit my Bank of America calls. And, when I entered the position yesterday, I talked about, hey, if he gaps down this morning, I've got to go. I have to go. I cannot stay in it. I have to move out and move out quickly. It opened down, and you could see the first minute on it. It dropped about 15 cents in that first minute. And I'm watching it, and it's just not wanting to bounce, and it was kind of dead order flow coming in. So I just had to go take my $300 loss and move on and go from there. So I think that puts the challenge around 2,700, somewhere around there, 2,700 here with it. So, a ding and, never something I want, never something I want to see, but, doesn't really change the challenge, in a big way there with it. But, you can see Bank of America has just been dropping ever since. Now, in my note this morning, I put that I'd look to be a buyer around the 2780, 2790 level. And Bank of America quickly came down to it. I've been watching it going, okay, do I get a chance? I just haven't gotten a signal to be able to jump back in. There's just nothing there for it here, just yet. Breaking below some fairly significant levels. Here with it, we're seeing the rest of the banks, drop. A lot of talk out there, a lot of chatter out there on yield curve. And we even saw the Fed Williams talk about it here today. And this inversion of the yield curve that happened overnight. Now, yield curve is one of those concepts that how should I put it? It becomes very popular from time to time, and it's one of those concepts that is, from my experience and from what I've seen and from what I hear on TV and what I hear from other people, it is a very misunderstood concept. And in fact, many so-called experts on TV talk about it and are basically just way off base when they do. In terms of, what the significance is, what the meaning is, and what tends to happen afterwards here with the yield curve. But all the yield curve is this, and it's this concept that front end month treasuries. Okay, so if we come down here below short-term yields. And all treasuries are debt instruments, right? So if you give the government your money, right, you give them $100, what interest rate are you going to get? If you give them $100 for 3 months, you're going to get a different interest rate than if you give them $100 for 30 years. Why? Well, generally to adjust for inflation, right? As there's economic growth and inflationary elements that come into play. And one of the things what happens is they plot this yield curve where they show what the interest rates are essentially for different time periods of debt. And if you walk into a bank and you go get a CD, right? It's a similar concept. They're going to pay you less for a 3-month than a 30-year, right? And heck, I haven't looked at CDs in so long that I don't even know if they have 30 years anymore, or ever did. But essentially, it's the same, very similar thing. The way banks make money, though, is they tend to borrow on the front end of the curve. Is where they borrow money, right? Their deposits from from savings accounts, checking accounts, CDs, those types of things. They're borrowing this money at what is the front end of the curve or something around that level, and then they're doing auto loans and home loans and business loans and all sorts of other things and 30-year mortgages, right? They're lending on the back end of the curve. So essentially, banks' profits traditionally arise from the difference between the back end and the front end of the curve. Now, there's a lot more to it than that when it comes to banking and how they make money and all of that. But, in simple terms, when the yield curve is steep, meaning when the front end is much lower than the back end, so if it were to look like this, banks are making a lot of money. When the yield curve is flat, banks aren't making money. And when the yield curve is inverted, what they call inverted is when the front end is actually higher than the back end, banks are losing money. Now, there are a lot of factors that can push on this yield curve. One of them is the Fed. And the Fed has been raising short-term rates. The Fed has no influence on the back end. They don't go set these rates. The Fed can push on the front end, and it can push it up, and it can push it down. But what the Fed doesn't have control over is what happens beyond that. And so what tends to happen is you get into interest rate rise environments, like here in 2006. And here's the yield curve in September of 2006. And the Fed had been raising rates for a few years. And you get these environments where you get this yield curve that is just flat, right? And a lot gets made out of it because one of the things that happens before an economic recession is we tend to see the yield curve flat or inverted. In this case, inverted. The front end is higher than the back end. Look at the date, though, September 1st, 2006. Notice the S&P went significantly higher afterwards. Okay, this whole concept that, yield curve inverts, then market has to go down. It's not a knee-jerk reaction. It's not an if-then. It's not a, wow, it inverts and tomorrow the market drops. The market can have years worth of upside left in it after the yield curve inverts. In fact, you can see how the yield curve evolved. If we go and look at October of 2005, the yield curve is, pretty healthy. But in the next year, yield curve, flattens out. Well, by the time we get to August of 2007, well, the yield curve is back to normal. Right? The yield curve is no longer inverted. The 20 and 30-year little inversion there, but it's no longer inverted. And, then the market drops big. Okay, so there's this idea that, market's going to move based on the yield curve. The yield curve can give some warning, and there's some value in looking at it. But it is one of those things where some of the if-then data out there is just frankly pretty shoddy in terms of what its significance is. But what is going on today? Well, today we are looking at a yield curve that inverted with some of the shorter-term bonds, meaning the back end versus the front end is still a pretty good, for what has been post-financial crisis, a decent yield curve. But this kind of front end right here inverted here overnight and yesterday. And so a lot of hubbub being made about that. It's creating some fears out there. And the implications are, if you're bearish, implications are, we got big sell-off coming. If you're bullish, you're just going yawn, snooze. We've seen this so many times, and the market has gone higher almost every time. There's only a few times where you can look back and see this kind of kink of inversion and then see the markets drop afterwards. Okay, but overall, that's some of the fear, and that's some of the fear that's coming into the banks here today. And in terms of Bank of America, not to belabor the point here, but in terms of Bank of America, gap down this morning. I didn't need yield curve. I didn't need any of that, to know, okay, time to go. Gap down below the 7-hour, gapped and broke yesterday's lows. Just had to go. Had to leave, and was not worth being patient here with it. Now, is it worth picking up anytime soon? Well, yeah, when my indicators get a little oversold, sure. I'll definitely take a look, and I'm definitely willing to be a buyer of Bank of America, oversold position and on the next bull signal. Today doesn't change, my bullishness. In fact, I find it really interesting. We're getting some data here today from TMAnalysis, and some greater clarity into their earnings and whatnot. To me, it's just one of those things where, we're going to continue to see these ups and downs in the banks. But I don't think today in the talk and the chatter out there is anything game-changing for them, other than, puts any kibosh on the breakout, right? But we talked about J.P. Morgan yesterday in this breakout, and that if it holds, then very bullish, and it has not held. But at the same time, we're still potentially higher low, right? It can still go lower and be a much higher low, which I do think would be very buyable if it does create that, or if it does have that. Now, as I'm talking here, I'm watching the market just absolutely melt, just absolutely melt. So I'll retitle this video. We'll go take a look at the technical breakdown of stocks in the watch list here after this video, but let's just focus on the market right here. But you can see the S&P absolutely melted. Huge volume starting to come in here, 18K, so not enough for me to say, hey, that's bottoming volume, not on a day like today. One of the things this morning that we saw is that the VIX was holding pretty steady. In fact, the VIX was actually red shortly before I got on video, and now the VIX is up. Huge. You can see the big move the VIX has made right here in a very short time period. And this is small cap wreckage here on this latest move too. I mean, this is just small caps getting punched in the mouth, down 250. Some of that because of transports with FedEx. Basically, analysts coming out and saying, hey, FedEx is nobody's really taking into account the risks that Amazon poses to FedEx, and and so FedEx is just absolutely getting walloped here today, down 6%. We're seeing UPS down almost 7% here on that on that news and on that chatter. So real big drops in those names. Things like Caterpillar just getting wrecked here today. So it's very red out there. When you look at a FedEx or a UPS, it's breaking key levels, right? When you look at a Caterpillar, man, it's not even breaking below the 7-day moving average. And some of this wreckage that we're seeing out there is very Caterpillar-like. I mean, yeah, Boeing's down, but it's still not anywhere close to its 7. And you just, we don't see that very often. But, the Bank of America's, J.P. Morgan's, those types of things, they're definitely breaking below their 7s and, and getting railroaded here, so to speak, even as I talk, from consumer discretionary to semiconductors. There's really just not much of a safe haven in this market today, outside of Pepsi and Verizon. And these two, when we've talked about it before, these two have been two stocks where when the market's red, Pepsi tends to go up and Verizon tends to go up. They have been two big safe havens, and we saw both of them down pretty big yesterday with the market down, or excuse me, with the market up. But both of them holding in there here today. With the with the market with the market on down, but bonds moving on up, dollar moving on down. There's while we didn't see a big move in the dollar yesterday, we saw a gap down in the dollar today, and that was one of the things where I looked and I said, maybe the market turns around this morning, but then we started to see the dollar get bought up, very very quickly, and you can see where bonds are and the big move up here in bonds. And really kind of has the smell of a safety trade, of a safety move by investors here. So that's some of the stuff that's going on as things continue to melt down. As I look at them on my other screen here, so looks like. Let me grab the news here. Okay, all right. All right, looks like Gunlock is commenting on bonds and the implications of the yield curve, and that's one of the things driving this last little bit of move. He's pretty infamous bond guy, and just basically saying, hey, what's happening in bonds is signaling a recession. So that is helping to drive things here, at least from what I see on the absolute surface. But price action very red. Very negative, and some heavy volume starting to come in right around about Friday's highs. In fact, here we go. We're breaking Friday's highs. We've now filled the gap from the trade talk and market pretty much where it was Thursday and Friday. All right. Give me about 5 minutes, just take a look at things. I'll jump back on, and then we'll go and break down some of the technicals on the stocks in the watch list and where we go from here. We'll talk to you soon. Take care.